right? So let's focus on today. Yeah, this company fell by 49% from the recent high. I mean, so what company is this that we are talking about that relates to my meeting right before that at the Capitol building, which is somehow dealing with curing diseases or illnesses? Now, let me share with you why and how we found this company, right? Now, we found this company way back in 8th of April 2020. That was just, I think that was the first week where Singapore went for a lockdown. Yeah, first time, right, in Singapore's history, we went for a lockdown. So we find that the price is really undervalued. So we found this company, we announced to our subscribers. So eventually, I think we were also quite lucky, right? Subsequently, there was a bull run, right? So the share price went up by 91%, and then it hit $20. So it's almost a 100% return in about 1 year. But two things, right? One is the company, it was a good company. Second thing, it was also a bull run. So when these two things come together, right, about 90% in 1 year. Then subsequently, you know, the fall season, right? Yeah, fall season. So after a sunshine, suddenly there's a rainfall, right? So as of this afternoon, the price went back to its original $10, which is why we want to talk about it. So is this another buying opportunity for us to make another 90%? Now, but before we talk about this company, I think I will need our teammates' help to play a very short video. Now, let me share with you what this video is all about, right? Now, this video is about the story of the patients who has benefited from the drugs that they are taking manufactured by the company that we're going to talk about. Okay, so I'll let our teammate play this video so you hear from the patients themselves.
I live in a world of complete darkness. I am totally blind.
I've been blind since birth.
I lost my sight to eye disease.
I lost my sight in Afghanistan, and it doesn't hold me back.
But my blindness can affect my sleep patterns.
I go through periods where it's hard to sleep at night and stay awake during the day. But I learned that my struggle was with Non-24.
Non-24 is a circadian rhythm disorder that affects up to 70% of people who are totally blind and can't perceive light. Talk to your doctor about your symptoms and learn more about Non-24 by calling 844-844-2424. That's 844-844-2424 or visit my24info.com.
Now I know that Non-24 is real.
And I'm not alone.
It's time for a new day.
Interesting, right? So the video talk about like an illness called a circadian rhythm illness, Non-24. Now, just a very quick background because my first degree is in biology, right? Now, just to let you know that a typical human being like me and you, we actually have this certain rhythm called a circadian rhythm. In other words, our mind has a ability, right, to know when to rest and when to work. And of course, during the daytime, we work, right? And then nighttime, we sleep. And the reason why we do that is because light forms a very important cue, right, for us to know when we are working. So daytime light, we know we're supposed to work, and then sunset, we know we're supposed to sleep. But for blind people are different. Blind people, it's 24 hours of darkness. So how do they adjust their circadian rhythm, right? Now this is very important. To all of us, we take it for granted, right, daytime and then nighttime. But for the blind people, it's a different thing. Yeah, and since they are a minority, I think it's important for pharmaceutical company to come out with some form of drugs to help these people. And the company that nobody, probably most of you have never heard of, is called Vanda Pharmaceutical Company. And let's talk about why we talk about this company, right? Number one, it's a small company. Yeah, a big company, you know, Tesla, everybody talks about. So I'm more interested in small company, defined by small market capitalization, right? And the reason why I'm more interested in small company is because small company tends to be fast growth. Yeah, so I don't make like 5%, 10%. I want to talk about like 200%, 300%, 400%. So to have that kind of growth, we cannot buy blue chip stock like DBS or McDonald's. We have to go for a small company. But remember, right, once you go for a small company has significant risk. So, but let's come back to here, right, small company, because I wanted to search for a fast growth company. Second thing, right, is Vanda Pharmaceutical is a pharmaceutical company. And just to let you know that I don't really like to invest in pharmaceutical company, partly because it's so complex, they got tons of drugs. But for this company, I don't think their drugs exceed 10, so it's just a few. So at least for me, I think it's a bit easier as compared to pharmaceutical companies with 50 to 100 drugs. So a few drugs, easier to understand, and it's also easy for us to talk to you, right? And the next one, we felt that right now it's back to its 52-week low. So there's a lower downside, but there's a higher upside. Yeah, so these are the reasons why we want to talk about this company today. And of course, one of the most important thing, right, is only one analyst talks about it. So if you look at here, right, this number over here, 1. So what does it mean? I pull out this information at Yahoo Finance, and whenever I want to know whether a company is so-called boring or popular, right, I go to Yahoo Finance, type in the company's name, and then I look at the number. And if the number is on the low side, a single digit, that means nobody talks about it. And if nobody talks about it, price, right, tends to be depressed. But if you Yahoo Finance, Facebook or Tesla, you will see 20, 30 people talking about it. So when more people talk about it, the price tends to be high, right? Yeah. So as investors, we want to go towards the direction where people are not there. Yeah. So we are contrarian, right? Yeah. So tonight we're going to talk about this case study together with Zhen Hong, right, our author on this company called Vanda Pharmaceuticals. But before I hand over my airtime over to Zen, right, or Zhen Hong, I think I better read this one for him. All the boring stuff, let me do it. So let me start with this. So remember, the purpose of this evening's case study, which is Vanda Pharmaceuticals, is solely to illustrate the application of value investing methodology, because I am a value investor, and various valuation method, we talk more about this later on, in the context of real-life company, which is Vanda Pharmaceuticals, so that all of you can continue to learn value investment method, and of course, we have opportunity for us to provide investor education. So remember, right, for tonight, under no circumstances does any of the information shared tonight, whether by me or Zhen Hong, right, represent a recommendation to buy, sell, or hold any stocks. So if you own self press own self, right, you own self take responsibility. So remember, the illustration, the case study, which is Vanda Pharmaceuticals, is just to demonstrate the application of value investing. And remember, we do not take into account your individual characteristic, profile, or risk appetite of any given investor. Remember, in no event shall ViA, myself, or Zhen Hong, right, be liable for any viewers, guests, third party for any damages of any kind of the information sharing here. So let me just jump the gun a bit. So remember, neither Mind Kinesis Investments Private Limited, ViA, nor the authors, which is me and Zhen Hong, right, are operated or affiliated with any broker, dealer, or licensed advisor. In short, when we talk about this company, we don't get any benefits. Benefits, right? Yeah. So remember, past performance is a poor indicator of future performance, which is true in some extent, right? Remember, neither ViA nor the authors, which is me and Zhen Hong, makes any representation or warranty as to the completeness or accuracy of this information of tonight's case study. So before I hand over to Zhen Hong to talk about this Vanda Pharmaceutical, remember, right, a session like this typically will be held during our quarterly gathering with our subscribers, so that we provide with them the updates and so on. So Vanda Pharmaceutical was being published somewhere in April 2020, right? And today is just to provide our subscribers the update. But we decided to open up to all the audience that's been watching this. Yeah. Oh, so Limi say the company where first sold options. Yeah, first options. Yeah. So Limi, I think most likely your put option would have expired. Expired. Okay, got it. So it's the intention. Remember, it's like a gathering, right, for our subscribers, but we decide to open up to you. So, Zhen Hong, you're ready, Let me just make sure that you are our co-host, right? Then I hand over to you. Okay, you're already a co-host, right? So I'm going to stop share, right? Zhen Hong, anytime you're ready.
So, good evening, everyone. My name is Zhen Hong, and I'm from ViA 32. Okay. So, as introduced by Cayden, today we're going to review this company called Vanda Pharmaceuticals. Okay. The ticker symbol is VNDA, and it is our US case study number 2. So today we are going to do an update. So for all intent and purpose, our agenda for today, as mentioned, is update for our case study subscribers, as well as to showcase what this case study initiative is all about to new viewers. Okay, so we are very lucky today that Vanda Pharmaceuticals has just concluded their financial year of 2021. As such, we have all the numbers that we need to run our analysis based on the latest Q4 for 2021. Okay, so let us begin. with the forming questions within our circle competence, which are what, where, type, and future. So for what question, right? Vanda is a biopharma company that develops and markets specialized products that treat unmet medical needs. So unmet medical needs is broadly a term, right, used to describe medical diseases or medical cases, right? They are more often or not, they are not resolved in this current age now. Okay, so example of unmet medical needs are things such as a cure for cancer, or something closer to our current lives right now, drug treatment for COVID-19. Okay, so back to Vanda, right? This company was incorporated in 2002, and its headquarters is in the States, US, Washington, D.C. Okay, so now it appears that Vanda's flagship products are Helios and Finep. Okay, so regarding the flagship products, some information bites here regarding them taken from the investor presentation is that Helios is a drug used to treat the non-24 that you would have seen in the short clip just now. Okay, it's a non-24 sleep-wake disorder. Okay, so as mentioned in the clip, patients suffering from non-24, right, have their innate body clock failing to synchronize to the natural 24 hours sleep-wake cycle. Okay, that's why they need such a drug to help them to resynchronize to the natural 24-hour cycle. Okay, now moving on, we have Finep, okay, which is a treatment for schizophrenia. Okay, so now for subscribers, right, the author of the case study has taken the time and effort to explain these diseases, and for me, I shan't go into much details. Okay, and for those who are with the keen eyes, right, you might have already spotted the net sales for both of these products in 2021. Okay, then from the numbers, we can verify that a significant portion of the sales are from Helios. However, right, there is a need to take the geography into consideration, as Helios is approved in the for sale in the US and Europe, while Finep is only approved in 2 countries, the US and Israel. Okay, so here we have a pie chart representation of their 2021 net sales. Okay, seeing how Finep is able to generate about 1/3 of their net sales with just 2 countries alone, right? Interested investors should not sleep on it, pun intended. Okay. Now, this leads us nicely to the where question. So, Vanda Pharmaceuticals, they mainly operate in the US. However, with the number of patents and strategic partnership, right, it can be said to be a global company. So, from their 10K filing, right, Vanda acknowledged that their wide reach, is because of 5 key customers, namely Optimum RX, Accreditor, Amerisource Virgin Drug Corporation, Cardinal Health Inc., and McKesson Corporation. So these are basically wholesalers and distributors that enable Vanda to reach patients on a global scale. Okay, so a little fun fact here is that the letter 3 from Amerisource Virgin Drug Corporation all the way to McKesson, okay, this letter 3, right, okay, they are also customers of another company within our US case study list. Okay. Now, okay, speaking of patents, right, so here we have a list of patents that are registered for each of Vanda's flagship products. So I'm not going into much details of the patents itself, okay. The key sentence is at the top right, highlighted in yellow, okay, which basically states that the patents, although they are registered in the US, right, they have family members that are enforceable in other territories, such as Japan, Europe, etc. Okay. Okay, after where we have the type. So we are mainly looking at the type of companies, okay, whether they are fast growth, medium growth, or slow growth. So according to value investing criteria, right, any company with growth less or equal to inflation is slow growth. Then any rate above inflation but less than 20% is medium growth, and any rate above 20% is considered as fast growth. So previously, the author of the case study has calculated the growth to be at about 26% using our own in-house ViA calculator. And below here are the earnings per share chart, just to showcase what are the how the growth is being calculated. Okay. Now, bear in mind, this is as of the time of case study, which is 2020. Okay. Okay, so fast forward to this year, 2022, or rather their FY 2021. It is unfortunate that it appears to be no growth as the shift in the 10 years period, right, meant that our viable starting EPS, earnings per share, would likely be the 0.55 points in FY 2014. Okay. Then with the ending EPS of 0.58, right, for the latest FY 2021, it is logical that the growth rate would be low or no growth. Okay. It seems to be not viable to use the EPS for 2019 as it is not representative of the current situation. So do bear this in mind. Okay. Now moving on, as for the dividend, right, Vanda unfortunately is also not a dividend paying company as supported by an extract in their 10K filing. Okay. Okay, after type we is the future plans. So similar to other pharmaceutical case studies, right, we would be remiss but when evaluating future plans without highlighting pipelines. So taken from the investors presentation, we have a number of products currently under development. Okay, so long-time viewers will find the next phrase quite familiar, as I cannot stress this enough. So when we evaluate pharmaceutical companies, right, or any similar industries, right, it's worth noting that the product development in such industries take years and significant resources. So I highly beseech all investors, right, to take any product within the pipeline that is before NDA as a pinch of salt. Okay. The reason for that is that there is always a risk of failure during the clinical trials. Okay, it is not zero, the chance is not zero. And there are also fringe cases where despite the phase 3 clinical trials completion and despite having submitted significantly impactful data, right, the NDA might not be granted. So again, these are the things that I cannot stress enough. Okay, so the bottom line is that when evaluating pharmaceutical companies or any other research-heavy industries, right, do not count the chicks before they hatch. All right. So here is another snapshot of the company's pipeline from their 2021 10K filing. This can be viewed as Vanda's declaration on capital utilization. And we should see significant resource being channeled towards such causes and may likely affect the reported financial numbers in the following years. So again, we have to keep all these kind of things in mind. Okay. Another point to note is that there are two diseases underlined here in red. Okay, the Smith-Mejius syndrome, short form SMS, and the delayed sleep phase disorder, short form DSPD. Okay, they are part of the short-term goals set by the management, which I will explain in the following slides. Okay, so here we have the short-term goals highlighted by the management found within the investors presentation. So we have the launch of HEATLEOS for the SMS disease, tridibidine for gastroparesis, which is layman term means the partial paralysis of the stomach and the food cannot make its way through the organ as efficient as before. Okay. So right below we have the initiation of HEATLEOS for the delayed sleep phase disorder, DSPD, and the FINAP programs. So most of these are pretty straightforward and self-explanatory. But I would like to draw attention to tridibidine goal, as Vanda has recently in early February reported the results for their phase 3 clinical trials. Okay, so we see this part here. So this happens to be one of the time where phase 3 clinical trials did not use satisfactory results. So unfortunately, the treatment using tridibidine is not statistically significant when compared to the placebo group. So both trial arms, right, the tri-dividend trial and also the placebo group, right, showed a similar degrees of improvement. Therefore, Vanda is unable to statistically justify that tri-dividend is the better option. So this scenario is one of many cases, right, that happens to all pharmaceutical companies, and it reinforced my previous notion of don't count the chicks before they hatch. Okay. All right. So with that, right, we'll move on to moats, where we'll look into the qualitative aspect of it before going into the quantitative aspect. So similar to most pharmaceutical companies, right, Vanda's moat mainly lies in legal protection through the means of patents. So what is different from the traditional sense is that Vanda choose to engage in license agreement with other pharmaceutical companies. From the 10K filing, right, the company stated that they, by agreement means, right, receive exclusive global license under certain patents to develop and commercialize product stated within the agreement. So basically what it means is that Vanda, right, had an agreement with other pharmaceutical companies to obtain the rights, the sole marketing rights to such drugs under the agreement. Okay. So Vanda also exhibits two additional aspects of the moat, and they are the results of all these legal protection, which are the high switching cost and good distribution network. Okay, so the high switching cost, right, comes from the point of view of Vanda's customers. Okay, whereas the legal protection grants exclusivity and monopoly, right? So if the customer was to drop Vanda as one of their suppliers, right, the customer will lose out on the exclusive products which Vanda carries. So this is very typical of most pharmaceutical companies, right, unless the said company is vertically integrated. So what I mean by vertically integrated means they do everything by themselves, from research to manufacture to distribution to reaching out to the customers. Okay. Now moving on to good distribution, right? This is an indirect result of the partnership with the 5 major wholesaler, specialty pharmacies and distributors mentioned in the previous slide during the what portion. Okay, where they technically leverage on the reach of their 5 major wholesaler to indirectly reach out to other the end users, me and you, so to say. Okay, so this concludes the qualitative analysis of this update, and we'll move on to the quantitative portion, starting with the validation of the moat using the ROIC and WACC, which stands for return on invested capital for ROIC and weighted average cost of capital for WACC. So these are the 2 factors that we look into, right, when validating the presence of moat. So value investing criteria states that ROIC has to be bigger than WACC for us to quantitatively say that the moat is present. Then the bigger the difference, the stronger the moat. Okay, so here we have ROIC and WACC charts taken from Rule Focus. So the green bars are the ROIC and the red bars are WACC. Then at the bottom here, the black circles and line represent the differences. Okay, positive number means ROIC is bigger than WACC. Negative number logically means it's the inverse. So now don't be alarmed because this chart shows a very long time horizon, way back to 2010. Okay. So another point worth highlighting is that Vanda is able to reduce and maintain a small WACC as shown in the red bars in recent years. So you can see here the red bars are actually decreasing. Okay. Then the recent differences are positive numbers, so we can safely say that the moat is present. Okay, and the negative numbers in the front portion could very well be due to the resource draining aspect of research and development, where the returns are always considered as late bloomers. Okay, so after moat, we'll move on to the earnings per share. Okay, so here it is, as you can see, the EPS generally on a gentle uptrend. If we use the starting EPS of 0.55 and the earning EPS of 0.58. So value investing criteria states that the EPS has to be on an uptrend, otherwise it has to be stable. Okay. So while it is on a gentle uptrend, right, EPS went under the waters for some years. As such, this could only be a plausible pass in that sense. Okay. The repeated pattern here, right, is that much like ROIC, where 2020 appears to be the year that we need to focus on. Okay, so later on, from now onwards, right, we'll mainly be focusing on the year 2020 to see what had happened. Okay, so using the formula earnings divided by shares outstanding as a guide, right, EPS, for the decrease in EPS, right, okay, there are a few things that can happen: either earnings decrease or shares outstanding increase, or both. Okay, so for that, let's look into these two numbers, earnings and shares outstanding. Okay, now shares outstanding appears to be the easier one to retrieve, so let's look into it first. Okay, and we have taken this from Group Focus. We can see that the numbers appears to be constant over the last 5 years. Okay, thus we can hypothesize that the decrease in EPS is likely due to the decrease in earnings and not due to the increase in shares outstanding. Okay, to confirm that, we have to look at the earnings, which is found in the income statement. All right. So looking at the 2020 annual report under the income statement, we can see that year on year, Vanda is actually making more revenue. Okay. At the same time, the cost of operating also increased. Nevertheless, the revenue and cost seems to increase in tandem to each other. Yet the net income at the bottom here, highlighted in red, shows a decrease after 2019. Okay, to that, right, the main culprit is also highlighted in red, is called the provision or benefit for income taxes. Okay, so now we have the culprit, right? Let's jump back to 2019 annual report to look for this reasoning. Okay. So under the 2019 annual report, the management of Vanda explained that the 86.5 million tax benefit is due to the reduction in tax valuation allowance for deferred tax. Then the portion in green, down here at the bottom here, it's the management statement regarding this issue. Okay, TLDR in essence, right, Vanda has to re-evaluate its tax reporting process, right, to be in line with the guidelines set by the reporting agency, and this resulted in the 86.5 million tax benefit. So for me, I don't really come from a accounting background, so I always ask myself all this kind of, what is all this kind of definitions. So the next question is, what is deferred tax? Okay, so a quick search online, right, got me a layman explanation that the deferred tax is basically tax payable in the future. Okay, provision means the act of paying. Okay, so here we can see that the tax provided by Vanda is about 100 odd thousands in the year before 2019. Okay, but when we look at the recent years, the provision has gone up significantly. Okay, as such, we can conclude that the decrease in EPS is not due to the increase in shares outstanding, but due to the decrease in earnings or net income as a result of having to provide for higher income taxes. Okay, so after EPS, right, we will move on to gross margin. Okay, so for gross margin, value investing criteria states that it has to be above 40%. If not, it has to be on the uptrend or stable. So for Vanda, right, okay, their gross margin has always been above 40% and looks to be stable in the last 5 years. Okay, therefore, in this sense, for gross margin, Vanda's gross margin is a pass in this aspect. Okay, to take note here is the lowest one you can see is slightly lesser than 80. Other than that, it's always more than 40%. Okay, so moving on, we'll look into the cash flow. Okay, so for cash flow, value investing criteria dictates that the cash flow has to be on an uptrend, otherwise it has to be positive or stable. Then free cash flow, the bottom here, is derived from the operating cash flow by subtracting the capital expenditure, or capex for short. So despite the cash flow being negative for a significant period, right, it is positive and uptrend from 2018 onwards. Therefore, this is a pass in the value investing criteria. Again, the negative vision is probably due to the resource-intensive R&D process, which is a common trait for the pharmaceutical industry. Okay. After cash flow, we look onto returns, specifically the return on equity and return on assets. Okay. So for return on equity, ROE for short, right, the formula is net income or earnings divided by equity, then the result multiplied by 100%. Okay. Then it has to be more than 15% according to value investing criteria. Else it has to be only uptrend or stable. Okay. Unfortunately for Vanda, right, Vanda's ROE didn't really fit the bill when it comes to the last couple of years, and this is a fail in that aspect. Okay. For the ROE to decrease, either net income or earnings decrease or the equity increase. Okay. So previously in the EPS portion, we have already established that the net income or earnings has decreased due to the increase in provision for taxes. Okay. So our main concern now would be to look at the equity found within the balance sheet. But for now, right, let us hold this thought and have a quick look on the return on assets, as both of them share very similar formula. Okay. So for return on assets, ROA, again, the formula is net income or earnings divided by assets this time, and the result multiplied by 100%. Okay. The value investing criteria is that it has to be more than 7%. Otherwise, the trend has to be an uptrend and or stable. So similar to ROE, Vanda's ROA has decreased to below the value investing criteria. Therefore, this is a fail in that aspect. Okay. Now, based on what was discussed, right? Okay, we have to take a look at the balance sheet for any signs of increasing equity or assets. So let us zoom into the 2020 annual report, as that is the year where the slump had happened. Okay. So looking at the balance sheet, okay, there are three main categories: assets, liabilities, and equities. All of them increase in tandem to each other. Okay. There isn't much jarring item that require us to delve deeper. Therefore, we can conclude that the decrease in ROE and ROA is largely due to the decrease in net income earnings, and to a plausible degree, an increase in assets and equity. So after ROA and ROA, next we're going to look at how the company manages its debt. Specifically, in this case, we're looking at the long-term debt, using debt over equity, debt to equity ratio. Okay. So debt to equity ratio is a measure on how much the company is borrowing to finance its operation. Value investing criteria demands that this ratio to be no more than 0.5. Okay. In other words, in ideal case, right, the company should not borrow more than half of its operating requirements. So if there's any beautiful chart for Vanda, right, this is it. Okay, the debt to equity ratio is very small, even going below 0.1, and this is a definite pass in the value investing criteria. Okay, so now we'll move on to see how well Vanda is positioned for the future using the SKIM or SKIM acronym. Okay, so it stands for specialized labor, competition, ability to raise price, as well as new technology. So for specialized labor, right, it is plausible that such labor is not needed as the moat is institutional. While there is a requirement of headhunting skilled researchers and engineers, right, Vanda is able to bypass that by having to negotiate license agreement on the products they desire. Nevertheless, right, it is always good for the company when such personnel, right, or such skilled laborers, right, are organic to the company. Okay. So moving on to competition. Competition appears to be manageable, evident by their gross margin being more than 40%. Okay, especially so when the mode of the race happens to be especially so when most of the race, right, of all these R&D race, right, happens during the sprints to see who can develop the product faster. Once victorious, right, the company will ride on the coattail of legal protections from monopoly, right? So this is how they combat competition, so to say. Then moving on, the ability to raise price, right, is tricky, as monopoly allows for the company to raise price up. But if it's too expensive, right, the reception will be very low. Okay, so pharmaceutical companies tend to tread this portion very lightly. Okay. Lastly, new technology definitely help the business because Vanda, as well as many pharmaceutical companies, right, they thrive on R&D. Okay. Moving on, this is our last part. Okay, we have the risk and mitigations. So right here we have three main categories. So firstly, on the sales side, we can see that most of the sales are connected to the big five customers, as mentioned in the COC portion, the circle of competence portion. So the main concern is that should any one of the big five drop Vanda as their supplier, it is very detrimental to Vanda. On the other hand, right, having legal protection by Vanda, right, means that Vanda has the ability to monopolize the respective product market as long as the protection remains enforceable. Then those who choose to drop Vanda, right, would then have to be content with the inaccessibility of the products which Vanda has exclusivity to. Okay. And internally, right, okay, the income tax portion continue to worry us a bit. As we can see from the provision for income tax is high in recent years after 2019. Then net income or earnings decreased due to that, although it could be a blessing in disguise that it shows that Vanda is committed to writing the discrepancy between them and the reporting agency. So actually this is something new that I learned when researching a US company is that every state in US have their own reporting agency. So it's actually very taxing for a lot of companies, right, to align their reporting practices, right, to the guidelines stated by the various states. Okay, so this is one thing that us investors need to take note. Then lastly, on the development side, right, there's always a chance of failure, and this is commonplace in such industry. And honestly, there's nothing much for the company to do other than having a robust response system to detect signs of failure early on in the development process. And the caution is that failures can still happen late in the process. Clinical trial phase 3 can still fail when the results are deemed not significant enough. So again, example, going back to Vanda's very own tradipitant phase 3 trials. Okay, and as mentioned also, the authorities could also decide to withhold granting the NDA to produce the NDA on the basis of needing more information. So there's a lot of factors going on with regards to R&D. That's why I'll always echo the phrase, don't count the chicks before they hatch. Okay. So to wrap things up, right, Vanda is a global biopharmaceutical company that specializes in developing and commercializing products for unmet medical needs. Their flagship product, Helios, is for sleep disorder, and Finep for schizophrenia. So the company mainly operates in US with a quasi-global reach by partnering with 5 major wholesalers, specialty pharmacies, and distributors. It was a fast growth company as of 2020, non-dividend paying company, but 2 years ago. However, it has regressed to low or no growth in the recent year. Okay. Future plans are focused on extending Helios and Finep monopoly years, as well as fostering tradipitant to be a next star product. Legal protection, high switching costs, good distribution network as the trifecta phases of the moat. Then EPS soared splendidly in 2019 due to the one-off benefit for tax income, and the dip after 2019 can be said to return to normalcy. So this is one thing we need to take note. Gross margin is well above 40%. In fact, very close to 100%. More 80 plus, I would say. Cash flow in recent years are positive and uptrend. ROE and ROA slumped in the last couple of years due to the unnatural spike in 2019. Debt to equity ratio is beautifully below 0.5. Vanda is well positioned for the future under the SKIM or SKIM criteria. And lastly, the three risks investors need to be aware are concentration of clienteles, income tax, and R&D failures. Okay, so with that, we have come to the end of this update session. I hope the information shared today will aid you, our subscribers, as well as new viewers in making your own informed decision. Okay, thank you.
Thanks, Zheng Ho. You just hang around, right?
Okay.
There is a question by Wendy, NDA. NDA is non-disclosure agreement.
No. Let me go back to the drug.
Yeah. Can you go back to NDA?
Slide, NDA.
New drug
Actually,
application.
because all this acronym, it's all this acronym. Where is it? Here. So an acronym is actually there's also an acronym for a lot of things. Like SMS can mean a lot of things. So for NDA, right, it's basically meant a new drug approval.
New drug approval.
Yeah, it's not non-disclosure, right? Although they share the same acronym lah.
Okay, good. Any other question? Maybe I say something first, then you all decide what question to ask, right? Remember the context of this company was discovered way back in April 2020, and that was also the period of time where pandemic just got started, countries went for lockdown and so on. So the share price was quite depressed, about $10, about $10, right? So subsequently it went up to 20, and then right now it's back to 10. Now, just now, right, for Zen, Zen talk about the risk. What are the possible risks, right? Now, let me share with you how is this risk factors eventually relevant to our entry point, right? So in other words, the higher the risk that you felt that the company have, the lower the entry point that you want for this stock. So in other words, if let's say you go through analysis or whatsoever, for any companies, you find that this company, wow, is the high risk, right? And we expect it to be a high risk because it's a small company. It's not an established company, it's a small company. And if it's the company, if it's a high risk, then the thing is, you want to make sure that you will lower the risk at the end, right? When you do the valuation. For example, if some of you are our grads, you may want to increase the margin of safety. You may want to adjust the growth rate to a lower number, and to see what's the entry point. And then for companies like this, again, small companies, right, we want to check the balance sheet. Yeah, just now we talked very briefly, right? Why we want to check the balance sheet is because the last thing we need is because they spend a lot of money on R&D, right? The last thing we need is they run out of cash, and then the company eventually go bust. So a small company require more stringent criteria to look at. Now, later on, right, I will deep dive into the balance sheet and then check for a company like this, right, which there's a bit of uncertainty, how much cash that they have. Yeah, if you buy the stock, right, the stock is about $10. If you buy $10, like how much cash do they have within this $10? The higher the cash, the better. Yeah, so let's go back to the question. The NDA application is the vehicle through which drug. Okay, so Roderick has helped to type in. This Roderick Low, the name sounds quite familiar. Oh, I think, are you my Facebook friend? Yeah. Sick. Okay, anyway, let's come back to here. Any other question you want to ask regarding this company? Now, previously, we always talk about Buffett's company. Yeah, Buffett's company are always with certainty. So we intentionally want to choose one a bit uncertain one. But remember, right, small company, we expect to fast growth. Fast growth is a bit uncertain. Like my company, very small, there's a high uncertainty. Yeah, so we have to leave the fact that if we want to invest in fast growth company, the greater the uncertainty. Yeah, then we need to adjust our intrinsic value calculation so that it's more conservative. Okay, any other question you want to ask? Now is a good chance, serious. Yeah, two key drugs, Two key drugs, right? Easier to understand, Helios and Fnac.
Yeah, these two.
Fnac. One for sleep disorder, and then one is schizophrenia. Schizophrenia is a mental illness. Yeah, big companies, many drugs. Quite hard to understand. No question? Oh, you're the trainee for May. Okay, good. Very good, huh? Okay, any other things? Sure, no question. No question. Okay, no question. I think we will how to adjust intrinsic value. Wendy, don't worry, May you attending our course. Yeah, May, then we tell you this is a bit too complex, right? To be shared in this context. Don't have. Okay lah, don't have. Zen, thanks.
Okay,
Yeah, thanks.
bye.
Bye. Thanks, Zen.
Mm.
Okay, so right now I'm just going to share screen, right? Going back to a Zen slides. Now I'm just going to pull this up, and Zen has shared one very important thing, right? For example, remember this number over here. Okay, you take this number, boom, and then you say fast growth, right? Yeah, and then you may not be careful that the reason why this number was very high because there was a high provision of tax. Then it make a very small number very big. Yeah, so this one is short, like it's a one-off. It's good luck, right? So if I strike off this number, if we go from here to here and then to here to here, I think it looks more realistic. Now, but again, just to let you know that pharmaceuticals EPS can be quite lumpy, right? Lumpy in the sense that if they introduce a certain drug, and then eventually this drug can reach the market, you may see the EPS spike up. Yeah, spike up. So just be mentally prepared. A Buffett stock's EPS will look something like this. Very nice one. Yeah, so at night you can sleep comfortably. You don't need the Helios. Okay, so at night you sleep nicely. This is a Buffett style of stock. But if you are investing in a fast growth stock, fast growth stock is the beginning few years is negative, which is what is reflected here. Can you see here? This is, you must accept it. Like fast growth company looks like this. And then one day it reaches here. And then suddenly, boom, and then it goes up. So this is a bit of high risk bet. High risk bet, right? So you want to reduce the risk. Again, I'll share with you how to reduce the risk. Or sometimes the first few maybe a bit of positive, negative, and then suddenly, boom. Yeah. So which also means that the bet, right, that the investor take is they do whatever due diligence, right? And then maybe they buy a small amount over here. And then some of the drugs eventually go into the market, and then you see the EPS jump up, gap up. And then if the EPS gap up, sometimes the share price also gap up. That's where the 100%, 200% may come from. Okay, So remember, this is the kind of Buffett stock where you sit nicely and only Helios. A fast growth stock is quite risky, right? It's quite risky, right? So during our YouTube live, we're going to share a variety of stocks. Hi, this is Cayden from ViA. Welcome back again. Now, just now when I was making a cup of chocolate, right, I saw some pornographic link, right, at our chat. Wow, so nowadays they're everywhere, When you do live, they also want to come in, you see. Ask you to learn investing. Don't post this kind of thing on our video. Very bad, right? Hot girls and boys. Alamak, please. Okay, so let's come back to here. Just now we have quite a great number of registration coming in, right? So remember the registration is still open by our teammates, so you can see that all the link is over there, right? Now, so let's come back. What's going to happen in the next 10 minutes is going to be very important because we're going to talk about the entry point, and there is the company, which is Vanda Pharmaceutical, right? Is it still a viable buy? Okay, I got it. So right now you should be able to see my slide. And because Vanda Pharmaceutical is a small company, fast growth, and small company tend to have a higher risk, right? So we need to focus on some numbers. Because if it is a high-risk company, the last thing we need is today we press buy, tomorrow it close shop. Okay? So we do not want the company to close. So we want to protect our capital. So in order for us to have some assurance, right, in terms of numbers, that the companies most likely will not close. Most likely will be around. And not only they will be around, they will be able to grow. We are going to look at one financial statement which is called balance sheet. Now, in case you are not our graduate, now just to let you know that balance sheet is simply a document. Let me just write this down, right? It's simply a document that record down, right, what are the things that a company own and what are the things that a company owe. And whatever things the company owns, we call it assets. So this is like an accounting term. And then assets, there are two types. One is called a current asset, in which can be liquidated, right? Or can be sold, or can be converted into cash in 12 months or less. So anything that can be converted to cash in 12 months, we call it current assets. So the most liquid, right, current assets is actually cash, because cash no need to convert, right? So they're highly liquid. And sometimes company will possess certain form of current asset in the form of bonds, or sometimes they also buy stocks. Yeah. So in the current asset, sometimes you see the sentence, cash and cash equivalent, because you convert, it become cash. So current asset. So in other words, under the assets part, right, the one that's most precious, most valuable is actually cash and cash equivalent themselves. Now, then there's another type of assets called non-current assets. Predominantly land, machinery, which will take like more than 12 months to liquidate and convert to cash. Yep. So we want this. We want company to have a lot of this, right? Remember, just now we said that Vanda Pharmaceuticals is more on the high risk side, right? So we don't need to close, right? So if the company has a lot of cash, how to close, right? Now, for example, if your HDB loan is paid off, your car loan is paid off, and then your bank in your pocket got a lot of cash, unlikely you go bankrupt because you just have too much cash. Now, so assets are things that the company owns. On the other hand, right, liabilities are things that the company owe. So, for example, right, Vanda Pharmaceuticals will have current liabilities. That means things that they owe, but they need to pay within 12 months or less. And on the other hand, it's non-current liabilities, so bigger than 12 months. Yeah. So this is the basic terminology, right, that as investors we need to know, which is why in our case study, we need to explain all this. You cannot just buy a stock and then don't understand anything. Yeah, so we have a team of people that is driving this, yeah, so that you stay with us, stay with us, right? Now, so ideally, if we want to buy Vanda Pharmaceutical, we will expect Vanda Pharmaceutical of assets to be larger, right, than liability. Yeah, it cannot be asset very little and then liability a lot, right? Cannot be, right? Yeah, so we want to have more assets and then lesser liabilities. So once you have understood all these important terms, right, that's shown here, let me introduce one term called the net cash per share. But before I even come to this net cash per share, now this is the balance sheet, correct? Balance sheet. So remember, balance sheet has a current and non-current, right? So here, let's talk about only the current. Assuming that the whole company's got no current, only current, right? So if you look at here, remember, the most valuable is cash and then cash equivalent. So you realize that this number is 432. It's actually 432 million, 432 million, right? And you may notice out of the total current asset, about 478, a huge chunk are cash and cash equivalent, which is a good thing. Yeah, the last thing you want is you want raw material, all these things which are worthless. You don't want a lot of this raw material. Yeah, you want more cash because they're high risk, right? You want to have more cash. Now, then net cash per share, the formula is simply taking the cash and cash equivalent, which is this 432, right? So I just put 432 over here. Remember, it's million, right? Minus away the total liability. In other words, a small piece of this, right? We use it to minus all the total liabilities, and then divided by the number of shares that they have. I'll end up with a number which is $6.15. So what does this mean? It simply means that this afternoon, Vanda's stock price is $10.94, which also means that if you buy one stock, let's say you go to the stock market, you pay the stock market $10.94. So you have one share of Vanda Pharmaceutical. And if this one share of the pharmaceutical is like a box, and the share is contained within the box, right? Remember, you paid $10.94 for it, which also means that if you open up this box, what do you see inside? Yeah, 56% inside this box consists of cash, which means that out of $10, $6 is consists of cash, and you are effectively paying only $4. Yeah, $4. But to give you a reference, that 56% of this, right, consists of cash is a lot. Let's use a very popular company called Tesla. Yeah, Tesla, everybody go and press buy, right? But if you look at the net cash per share, remember this is a formula, right? You take whatever, you see, if Tesla is really a super company, make a lot of money, and then recently, they sold a lot of cars, right? They should have a lot of cash, So if you take the cash and cash equivalent, Yeah, minus this divided by outstanding shares, in fact, it's a negative number. And then right now, if you buy one share of Tesla, it's about $1,000. So in other words, if you open up the box in which you paid for, right, which is $1,000, you open up, you see no cash, there's nothing. Not only that, there's a negative. Yeah, so in terms of the balance sheet, actually for Tesla, it's quite weak. But doesn't mean that it's bad, right? People are buying Tesla betting on the future. And Zen, which is Zheng Hong, right, he has warned that for companies such as Vanda Pharmaceuticals, you never count the eggs before they're hatched. Yeah. So the lucky thing is, if I go back, yeah, this is a cash-rich company. This is a cash-rich company, and this to ensure, give some assurance, right, that likelihood in the near term, unlikely is going to go bankrupt. Unlikely. But I'm going to provide more numbers to support. So net cash per share is $6. Out of $10 stock that you buy, $6 is cash. Well, that's really good. Yep. And then the next one, I'm going to talk about this ratio, right, called the Altman Z-score. It's something new. It's something new. Now, if you are our US case study subscribers, we constantly introduce you new things so that you get to learn. Right? Now, this Altman Z-score, right, is to use to predict the probability that a firm may go bankrupt within 2 years. Remember, it's a high-risk company, so you want to give our assurance that it doesn't go bankrupt in 2 years, and then not only that, the share price will go up. So the score is 5.25, but what does it mean? Now, this is the range. If it's less than 1.4, it's distress. Yeah, if it's here, it's gray. Like, want to die, don't want to die, right? But if it's more than 3, in this case, it's more than 3, it's in the safe zone, which means that in the next 2 years, unlikely the company is going to go bankrupt. And of course, it's further supported that they have so much cash. Cash rich, right? And then not only that, we want more assurance, right? Assurance. So let's look at this Piotrowski F score, right? Yeah. This number is equal to 6, but what does it mean? There is like a legend, right? Now, this score, right, range from 0 to 9 is to reflect 9 criteria. And these 9 criteria is used to determine the financial strength of a company's financial position. That means if the score is 0, it's really bad. Really bad. If the score is 9, it's the best. It's the best. So let's look at this Piotrowski score of Vanda Pharmaceuticals is 6. What does this mean, right? It's not 0. It's not really that bad. It's also not that fantastic. So 6 means it's a stable company. Fundamentally, it's still okay. Yeah. Supported by here, unlikely it's going to go bankrupt. Supported by cash. So far, so good. Now, so these are the score. 0 to 3 is really bad. 7 to 6 is really good. Yeah, so 6 is quite close. Quite close. Right? So stable, Now, then we also worried that in case the company is undervalued, right, we are worried that it's a value trap. Now, what's a value trap? Value trap is a type of company where it appears to be valuable, right, at a certain cheap price. And then when you press buy, the share price never go up. So it becomes a trap. So how do we know that this company, Vanda Pharmaceuticals, is not a value trap? Not a value trap. We look at this term called earnings power value. Now, by the way, see, I'm tossing all these terms to you, right? Yeah, just imagine if you are US case study subscribers, you learn all these things. So at night, sleep nicely, right? Like what Roger is saying. So in order for us to make sure that it's not a value trap, and it has some form of economic mode, durable competitive advantage, right? We want this EPV per share, right, to be bigger than book value per share. So let's look at earnings power value. It's $17, book value is 9. So left is bigger than right. So what can we conclude? It's not a value trap if the company is undervalued. Yeah, it also implies that the company has some kind of economic mode. Yeah, so this is like a summary in terms of valuation. But that's not the end, That's not the end. We want to add more value, right? Assuming that you are US case study subscribers. So let's look at the intrinsic value or the entry point from Guru Focus. Now, if you look at the Guru Focus here, this black line, right, represents the intrinsic value. This is the share price. Share price. So if the share price is below the intrinsic value, is considered undervalued. So you can see here, right, significantly undervalued. So based on Guru Focus, which is like one stock advisory site, they said that the intrinsic value is 16, and then right now is $10. That's why they draw a conclusion that it's undervalued. But remember, right, we cannot just blindly believe in what they do. Yeah, but we just keep as a reference. Yeah, keep as a reference. So let's look at Morningstar. Morningstar is another popular site that does valuation, provide companies, fundamental analysis, and so on. So you realize that Morningstar, right, further state that the company is undervalued with 42% discount. Oh, and share price about 10, right? Yeah. So as of now, these two perspectives, Guru Focus and Morningstar, state that it's undervalued. But remember, right, as investors, we must exercise prudence and we want to look at other valuation, in which only our US case study subscription does provide different perspective. So that's not the end, right? That's not the end. Now, during our 4 days value investing program, we talk about this valuation method called discounted cash flow. Now, discounted cash flow has many types. So during our course, we use earnings per share, right, to calculate the intrinsic value. Yeah, so it's still discounted cash flow, but it's earning based. Earning based. Another type of discounted cash flow, right, is actually a free cash flow based. So this is the second type, which is not covered in our 4 days value investing program, but I'm providing something new, right? New. So what I did was I used this number 0.24, which is the first positive number that I can get. The last point 1.12, right? And then I plot one line that goes across. Okay, so this point and this point. So I use free cash flow instead of EPS to calculate the intrinsic value. So what do I have? Yeah, I want to be very prudent, right? Remember, prudent, right? So I end up with an intrinsic value of about $10, assuming that their future growth rate is slow, you know, it's like 7%. And then not only that, there's still a 30% margin of safety. So this number is actually a very, I wouldn't say very, it's a conservative number, $10. So in other words, my intrinsic value is conservative, it's about fair value. So if I may summarize, right, Guru Focus is 16, undervalue, Morningstar 18, right, undervalue, and then ViA has $10 fair value. And then remember, right now it's here. Right now it's here. So if you do an average, right, for all the share price, it may be about maybe $14 to $15. Yeah, which is still undervalued. Undervalued, right? So that's based on the angle of intrinsic value calculation. So let's connect the dots. Remember, this is a high-risk company. We want to buy as low as possible. And as of now, right, let me just check. This July 21 is almost a 52-week low. 52-week low. So your downside is this, protected by margin of safety. Your upside is possibly double. Yeah, but just take note. It's very important that we have this portfolio allocation, right? And because it's a high-risk stock, in case, right, any of you want to buy, better keep this less than 5% out of this entire portfolio, 100%. Yeah, better stick to this rule. Yeah, 5%, so that you don't do 50%. Yeah, previously I watched one YouTube video. One gentleman say, my whole portfolio only got one stock. The stock is called Tesla. Wow, I have to salute him, Salute him, right? It's something that I got no guts to do. Yeah, but let's do some portfolio allocation, Now, and if you're worried, right? $10, yeah, you know, but you want to buy at 9, buy at 8, but right now share price is 10. So what can you do? Now, if you are our 4 days value investing program graduate, we can do this thing called selling put option. Yeah. So fortunately, right, for Vanda Pharmaceuticals, there are put option you can sell, and all these are monthly options. Yeah. So you just need to sell a put option, right, where the strike price is less than 10. Less than 10. Yeah. Actually, this afternoon when I was preparing the slide, I was very tempted to do a live demo and so on. But I think I better stop. Stop. As in, I'm very tempted to share a lot. But I think what I'll do is I'll keep this privilege to our US case study subscribers. Okay, so thank you all of you. So remember, we are VIA, which stands for Value Investing Academy. Our mission, right, for all of you is we care to make you a better investor. So have a good rest, and I shall see you soon. Okay, goodbye.